All right, well, thank you all for coming. Once again, welcome. My name is Noel Xavier, and on behalf of all of my colleagues at the Edmonton Community Foundation, I'm so glad that you were able to join us for this first online Wills Week sessions. But first, I would like to send a special thank you to an amazing group of volunteer lawyers. This year's Wills Week brings you 10 presentations, each unique to inspire and guide you in the proper preparation of your estate plans. These plans include not only a will to protect your family, your business, and your assets, but also 2 additional documents that help you during your lifetime, if you're temporarily or permanently unable to be as independent as you'd like to be. Understanding the hardships and additional costs that occur when these estate documents are not in place correctly will help you in preparing the value of getting professional help for you and your loved ones. This week, you've heard from lawyers about things done well, things gone wrong, how to plan for particular situations like blended families. A family member with a disability is what we're going to talk about today, and how tax planning can increase the amounts you choose to give. Later tonight, you're going to learn about how gifts that you include in your will to support your favorite organizations, and causes can save taxes and allow you to create a meaningful legacy. Edmonton Community Foundation is pleased to provide this Wills Week resource annually for Alberta-based will and estate information. It dovetails nicely with our usual role as a trusted resource for how organizations, large and small, enhance our lives here in Edmonton and further afield, and how to create gifts that reveal your values in a way that fits for you. So we shall begin. For this session, we're very fortunate to welcome a good friend of the foundation, Shelly Chamaschuk from Reynolds, Mirth, Richards & Farmer LLP. Shelly's practice focuses on corporate and commercial matters, business and succession planning, estate planning, including wills, enduring powers of attorney, personal directives, family trusts, and estate administration. She is the firm's Wills, Estates, and Trusts team lead. Shelly is a great presenter and wonderful friend of Edmonton Community Foundation and has done a number of these Wills Week presentations for us over the years, and we're so glad that she's back again. In addition, she is a lecturer at the Legal Education Society of Alberta, and she's a past presenter for the Metro Continuing Education at Edmonton Public Schools. We are thrilled to say that she has just been recognized as one of the best lawyers in Canada in the area of trusts and estates, but we already knew that. Shelly is also the past president of Youth Empowerment and Support Services Board of Directors. And so with that, Shelly, thank you so much for joining us today. I'm going to turn it over to you.
Thanks, Noel. And thank you, everybody, for joining us today. I'm happy to see that you have navigated your Zoom app and are online with us. So thanks for joining, and we're going to get started. What I'm going to talk about today is, first of all, a little outline of AISH and the requirements of AISH, and then some of the planning options that we have for recipients of AISH. Typically, disabled beneficiaries are also AISH recipients, and the testator or the person making the will or wanting to benefit that disabled family member wants to ensure that their AISH benefits will continue even if they receive money from a family member through an inheritance. So the planning options we're going to talk about include what assets are exempt under AISH that you can think about using to benefit that disabled family member. And we're going to talk about a new tool that we have since the last couple of years, which is establishing trusts for AISH recipients. And also we're going to talk about registered disability savings plans. And firstly, I wanted just to talk about charitable giving and wills, and Noel kind of alluded to this a little earlier in that we all know that generally a will allows you to make gifts to family members or to charities that you want to support or benefit after your death. And it's important to remember that there may be some tax benefits to your estate if you leave a gift to a charity in your will. And my understanding from Noel is there's another presentation coming up later today about some of those tax benefits. And you can leave gifts to one or more charities in your will, and those gifts can be in the form of cash or stocks that are in publicly traded or companies or private companies. And when you're leaving those gifts, they can be in a specific dollar amount or value amount, or they can be a percentage of your estate. And so it's often I find in families that have disabled members, that these families have been supported through charitable organizations that have helped them a great deal with dealing with the family member that has a disability. And it's important to family members to support those charities as well, to the extent that they're able. And so if that's something that you're planning to do, please know that you can do that in your will, and that there are some tax benefits for doing that. So the basic AISH rules. So as you know, AISH is an acronym for the Assured Income for the Severely Handicapped, and it benefits disabled persons who qualify in a number of ways. The first is that there is a living allowance, which currently has a maximum amount per month of $1,685. And that's money that's paid to the disabled AISH recipient. AISH also provides health benefits, and for many family members, this is the most important thing that the AISH recipient receives through AISH, is that often their medications or other health devices that they need are incredibly expensive, and AISH covers those costs. And it's a huge help to the AISH recipient and to the family. And when people are trying to leave money to their AISH recipient beneficiary, they're very cognizant of not wanting to do anything that would disqualify that AISH recipient from receiving those health benefits. And there are also personal benefits that an AISH recipient can receive, and those are based on the specific needs and specific cases for that AISH recipient. So the eligibility requirements for AISH is that the disabled person must be a Canadian citizen or a permanent resident. They must be a resident of Alberta. They have to be 18 years or older, and they have to have a severe handicap as that is defined in the Act. And they must meet an income test and an asset test, which we're going to talk about. So the asset test under AISH says that the AISH recipient, in order to qualify, all of the assets that they own have to value less than $100,000. They can own joint assets, and if that is the case, the AISH recipient is deemed to own that asset equally with the other joint owner of the asset, unless there's a contrary writing. So there's a document in place that indicates that the AISH recipient owns more or less than 50% of that asset. And there are some assets that are exempt from this test, and we're gonna review those, and those are very important and helpful for planning. So in addition to passing the AISH, the asset test, potential AISH recipient, in order to qualify, must also pass the income test. And the income of the person and their cohabitating partner, if they have one, must be less than the maximum living allowance amount in order to qualify for AISH. And there are also some income that AISH recipients can earn that are exempt from this test. So we'll review those in a minute. So firstly, let's talk about the AISH test and the exemptions the asset test and assets that are not included in the asset test. So they don't count towards that $100,000 limit. So first of all, the AISH recipient can own the principal residence, the residence that they live in. They can be on the title to that residence, they can own that residence, and that doesn't count towards their $100,000 asset value. In addition, the AISH recipient can own up to 2 vehicles, so have a vehicle or 2 registered in their own name. That second vehicle is one which is adapted to accommodate their particular disability. So if that is the case, then they can have those 2 vehicles. An AISH recipient can also have reasonable household goods and furniture, and though the value of those assets are not included in the asset test, they can organize a prepaid funeral, and that would not be included. And what has changed in the last couple of years that's really important is that an AISH recipient can now be a beneficiary of a trust, and those funds in trust are not will be exempt from the asset test, so they don't form part of that $100,000 limit. And the last very helpful tool is having a registered disability savings plan for that disabled AISH recipient. So the income test also has some exemptions. The exemptions include cash gifts. So if you give a gift to an AISH recipient, that is exempt. Any income tax refunds that the AISH recipient receives is not included in their income test. Any payments from a registered disability savings plan or an RDSP payment are not counted towards their income test. There are certain education funding programs where the income that the recipient receives is not counted as income for that income test. And lastly, there's some funds from government rental supplement programs that would not be counted. So that most commonly would be the Capital Region Housing Corporation. There are there's other exempt income, but those are the most common ones. And so that's those sources of income are totally exempt. And there's a category of income that's partially exempt. And those types of income include wages, training allowance, and severance pay. Or another category would be income such as interest income, dividend income, and income from a trust. So those are partially exempt. It's also important to know that when an AISH recipient receives an inheritance, there is a temporary asset exemption timeframe. So when an AISH recipient receives money that AISH does not consider exempt income, they have 1 year, 365 days to invest that money into an exempt asset. So it would be counted as a or else it would be counted as a non-exempt asset. So an example of that is if an AISH recipient receives an inheritance, and that inheritance is going to be put into a trust for them so that it doesn't count in their asset test. They have 1 year to get that money out of their bank account and into the trust account for their trust. So that would be the same if you had an AISH recipient who had a home. They owned a home and they sold the home. They have a year to move the proceeds from the sale of their home into the trust so that they are not offside on the AISH rules. Now, I wanted to spend some time talking about this idea of having a trust for an AISH recipient, because the rules in Alberta changed substantially in 2018. And it's a very important planning tool that lawyers now have and families have at their disposal. So you may have heard of what is called a Henson Trust. And this is a trust that is a discretionary trust that's set up for the benefit, excuse me, of a person who qualifies for AISH and is an AISH recipient. So they're called trusts for AISH recipients are called Henson Trusts because in Ontario in 1987 there was a case that went to the courts where a AISH recipient was taken off AISH because they had money that was set aside for them in a trust where the AISH recipient and some other family members were the beneficiaries of this trust. And the trust was over the asset allowance in Ontario for their AISH program. And the Ontario AISH program disqualified this AISH recipient because of the amount that they were potentially entitled to under this trust. And so there was a court case that was heard, and the court determined that because this trust was discretionary, meaning that the trustees of this trust had the discretion to decide whether or not to pay some or all of the money that was in this trust to this disabled family member, or they could pay it to other family members or not pay it out at all, that the amount in the trust could not be counted as part of the AISH recipient's assets because there was no guarantee that that AISH recipient would actually ever receive that amount. And so this became a very popular planning tool in Ontario, and also because the family name was Henson, it became known as a Henson Trust. So if you hear discussions about a trust or a Henson Trust, they're really the same thing, and there's no magic about a Henson Trust. That's just what people commonly call it. So in 2018, the government at the time passed legislation that amended the AISH legislation to exclude a person's interest in a trust from the calculations of his or her assets. And unlike Ontario, there's no restrictions on the type of trust that can be set up for an AISH recipient. So in Ontario, that trust must be a discretionary trust. Here in Alberta, it can be a non-discretionary trust. And what that simply means is that in the trust, you can indicate specific payments that must go to the AISH recipient at certain times or at certain ages or for certain things, and there's no discretion to your trustee to decide whether or not to pay those monies out so to the AISH recipient. So it's really almost a guarantee that they will receive those amounts, and that's a non-discretionary trust. So either a discretionary or non-discretionary trust is allowed under the AISH rules, and there's no maximum amount that over which would disqualify an AISH recipient from receiving AISH, or would then count in their asset test. So a trust is a very handy tool to use to set some money aside for an AISH recipient and not disqualify them from their AISH benefits. Now, I've been asked if a Henson's Trust or a trust that is allowable under AISH is a qualified disabled trust. Qualified disability trust. So a qualified disability trust, or a QDT, may be a trust for an AISH recipient. A trust that's set up for an AISH recipient would qualify to be a qualified disabled trust if it meets the guidelines that are in the Income Tax Act. And those guidelines are that it must be, number one, a testamentary trust. So that means that it's a trust that's formed when somebody passes away. It's formed in their will. The trust must be resident in Canada. So the trustees of the trust have to be Canadian citizens, or at least one of those trustees must be a Canadian citizen. And then each year when the trust is filling out its tax return, it must elect to be a qualified disability trust. The beneficiary of that trust must qualify for a disability, the disability tax credit. And if that is the case, then the preferred tax rates at the graduated tax levels will apply to that trust, as opposed to the highest graduated rate, which would otherwise apply to the trust. And a beneficiary can only have one QDT, or qualified disability trust. So families have to coordinate this and make sure that the trust that's set up for the beneficiary is a qualified disability trust, and that there's only one. So just a little bit of background on what a trust is and how it's established. So the components of a trust are that you have a person or persons called the settlers, who are giving the funds or the assets to support the beneficiary. The beneficiary is the disabled person, who often is going to qualify as an AISH recipient and may qualify for the tax credit. And the settler gives the funds to the trustees. Now, the trustees can be more than one person, and they are the trusted people who will hold the funds, invest those funds, and distribute the trust funds to the beneficiary. So again, you have at least three individuals who are involved: the settler, the person who's giving the money; the trustees, who are going to hold that money and take care of it for the beneficiary; and then the beneficiary is the disabled person. So how do you communicate what you want to have happen with the funds that you're leaving behind for the beneficiary? So that is typically done in your will, and because it's in your will, that would be a testamentary trust. And in your will, you can indicate all the specifics around that trust: how much you want to set aside in the trust for your disabled family member, and what the rules are around how that money is handled. Perhaps you want to indicate how that money would be invested by your trustees, when the money would be paid out to the beneficiary, to the disabled person, under what circumstances, and just some general rules that you would like your trustee to follow. The trust in the will can also indicate what happens if that trustee can no longer perform their duties as trustee, who would step in and take over as trustee. So the trust document can be as elaborate as you like it to be, or as simple as you would like it to be. The other way that you can set up a trust for disabled person is by doing that through a trust deed or a trust agreement. And that would be a trust that you would set up during your lifetime. So we call that an inter vivos trust. But that would not be a qualified disability trust. A qualified disability trust must be a testamentary trust, so set up upon your death. So typically families, when they are planning for a disabled family member now, they will put money aside in a trust and name others who will be their trustees of that trust, who will take care of the funds for their disabled family member. The other tool that we have that's really important in planning for family members with disabilities is a registered disability savings plan. And this is much like an RDSP, an RRSP. So the acronym is an RDSP, Registered Disability Savings Plan. And it really takes the place of an RSP for a disabled person. So in order to set up an registered disability savings plan for a AISH recipient or a disabled family member, that disabled person must first qualify for the disability tax credit, and the rules to qualify are different than our AISH rules, but and one of the differences is the definition of disability, and in the Act, the definition is a severe and prolonged impairment or physical or mental function impairment. And it is possible for a AISH recipient to not qualify for the disability tax credit. So that can be a stricter test than the AISH test in terms of the actual disability that the person has and whether that qualifies for AISH and for the tax credit. The maximum that you can deposit into an RDSP is $200,000 during the lifetime of that disabled person. Contributions cannot be made after the disabled person turns 59. So in the year that that person is turning 59, you can no longer make contributions to their RDSP, and the withdrawals from their RDSP must start when that person turns 60. It can be quite a process to set up an RDSP through a bank. I've had many clients who've indicated that it's been somewhat of a frustrating process. I think banks are getting better at it now. Some institutions are better than others at setting up these RDSPs, but I would encourage you that to use this as a tool. It does shelter $200,000 for the disabled family member. That's a lot of money, and it's a great way to set money aside if you're able to get through the process and your family member qualifies. The other nice thing about the RDSP is that there are grants that the government will contribute to the RDSP, and bonds that the recipient may qualify for. So there's a bit of a matching program that accompanies the RDSP. Now those matching amounts can be revoked if you contravene the rules of the RDSP plan. The other benefit of an RDSP is that the contributions cannot be attacked by creditors. So once the money is in the RDSP, creditors cannot come after the funds that are in that plan. And it's important to know that any contributions to the RDSP are irrevocable. So if you make a contribution to the plan and then you decide that you need to pull that money out for some reason, that would break the rules for the plan, and I think, in fact, it's impossible to take out that money from the RDSP after it has been put into the plan. So income is not taxed when it's withdrawn from the plan. Sorry, that's incorrect. All the money, all the funds that are in the RDSP are not taxed until they are withdrawn. The Income Tax Act allows for an RRSP, a RIF, to be transferred to an RDSP on a tax-deferred rollover basis. So what that means is very similar to an RRSP. When you pass away, if you were to gift your RRSP to a person, a disabled person who has an RDSP, and indicate that that's to go to their RDSP plan, then that money just rolls over into their plan. So from your RRSP into their RSDP or RDSP on a tax deferred basis. So no taxes paid at that point. So you can fund the RDSP and the tax that's paid in the estate of the parent or the grandparent who is contributing to that RDSP will be reduced. So there's some tax advantages to funding an RDSP through your will, and you certainly would want to, if that's applicable to your circumstances, you may want to see an accountant and get some further information about the particular circumstances in your family to see if that is something that you can take advantage of. So I just wanted to close by saying that in summary, there are many ways to take advantage of different planning tools to plan for a disabled person, and the ability to put money in a trust is really the game changer for a lot of families and lawyers that are helping families plan for a disabled adult. So the important things to remember is if you have a disabled family member and you're trying to plan for them, first of all, take a look at the assets that that disabled person can own that would allow them to continue to be an AISH recipient that don't count towards their asset test. So they can own a home, up to 2 vehicles, household goods. They can be a joint owner in the home that they live in, and those assets will not count as part of their $100,000 maximum asset test. Certainly think about establishing a trust in your will for a family member who you want to benefit. And again, you would want to indicate who you would want to act as trustees for that family member in your will, and set out whatever rules you want to impose on the trust in terms of how that money is going to be paid out and benefit the AISH recipient. And you could also indicate that upon that AISH recipient's death, that the money would then go to the next person or people that you would like to benefit from that money. And the last tool that's very helpful is an RDSP, so a Registered Disability Savings Plan, allows you to set aside a maximum of $200,000 for that disabled person, and it does not count towards their assets, allows them to continue to qualify for their AISH benefits, including their health benefits and their living allowance. So that's all I had for you today.
Great. Thank you very much for your expertise and sharing your knowledge and your stories with us. And to all of our listeners today and viewers, thank you so much for joining us. And so to the rest of you, thank you. We'll sign off. I will stop recording.